Coming up on the SBS On The Money podcast, Bitcoin hits a record high. US debt fears hits share markets, but the Australian share market falls less than the US. We'll tell you why next. It is Thursday, the 22nd of May, 2025. The Australian share market falling today. The S&P ASX 200 down by 0.5%. Scott Phillips from the Motley Fool will have the details in a few moments. But first to Bitcoin, which hit a record high today to be above 110,000 US dollars. For more, I spoke with Billy Leung, Senior Investment Strategist at Global X ETFs. Billy, so Bitcoin's gone on a bit of a roller coaster this year, falling to below 80 US thousand after Donald Trump's Liberation Day tariffs, but overnight it hit a record back above 110 now. Can you run us through what's behind its recent surge?
Yeah, definitely. It's been a roller coaster ride. And I think definitely in the recent times, recently, probably in the last week or 2 weeks, it's definitely more of a re-engagement of political possibility. One thing that people are looking to in terms of the key catalyst is probably tonight or the next few days where Trump will be holding a Trump coin holders meeting where he'll be speaking to all these holders of this Trump meme coin. So that's very likely going to be a huge catalyst in terms of how people view his policies or his actions towards cryptocurrencies. Other than that, we've actually seen a lot of flows in terms of cryptocurrency ETFs, and more to your point about Bitcoin. In terms of April, globally, we saw actually re-engagement of positive flows into Bitcoin ETFs, close to about 2.9 billion in the month of April, while we saw actually outflows in the previous 2 months. And, this was probably more resonating in Australia, where we've been consistently seeing ETF inflows into cryptocurrency ETFs. So I think overall, the strength in the past month or so has been a re-engagement of whether there is going to be some political certainty of the adoption of cryptocurrencies.
You mentioned Donald Trump there. Can you tell us a bit more about what kind of pulling power you think the US president has on Bitcoin and I guess other cryptocurrencies?
Yeah, no, definitely a good question. I think definitely more in the overall cryptocurrency space, he has an impact. And I think the key point to note is that he has, in his first term, he has been very focused on deregulation, which has been positive for the likes of cryptocurrencies. And more so for this term, there is a concern or there is more expectations of executive orders, policies, which may actually further open up the adoption of cryptocurrencies. And I think, the key main thing is because there's becoming a mainstream understanding of cryptocurrencies. But the key is, how can we further this adoption? How can we further this mass adoption? And this is going to be very much hinged on how politics or how regulations come about. And I think, to your point, to your question, this is where the US president or any government leaders really come into play, because, for the institutional adoption, for further mass adoption, for further usage of cryptocurrencies, this is the key.
You mentioned there that Donald Trump isn't necessarily just pushing the Bitcoin price up, but he's got an influence over cryptocurrencies in general, right? So given that we're seeing that Bitcoin price rise to a record high, is the gains that it's seeing being spread across all cryptocurrencies?
Yeah, I would say no. I would say right now it's pretty much been led to Bitcoin, which is very interesting to note because, we see across different versions or different types of cryptocurrencies, there are some which have correlation or have a beta moving along with Bitcoin, but Bitcoin is the key leader in that move. And I think the reason is because it's also an understanding of what cryptocurrencies really are. And something that we've looked into is that we've realized that Bitcoin as a cryptocurrency has been, behaving as an asset class of its own. The correlation with different kinds of assets, different kinds of equities, they have been coming down in the past, especially 3 years. And what I'm trying to say here is that there is increasing understanding of this, which means that when we do see a positive, backdrop or tailwind behind cryptocurrencies, it's really a quality matter as well. So I think Bitcoin has been leading the cryptocurrency, price surge, if you can call that. And I think that's because people do understand that there is a higher quality in terms of what Bitcoin possesses and to an extent what they adoption of it as well.
Is it still fair, though, to say that it's highly risky, especially when we look at the volatility this year alone falling so dramatically and coming back up again? Doesn't that volatility alone serve as a bit of a warning to investors, though?
Well, look, I would challenge that, mainly because if we look at the volatility or the ride of Bitcoin, we also saw that with equities and several asset classes as well. I mean, if we look at the US S&P 500, it probably dipped about 17 to 18% since Liberation Day, and we also saw the resurgence back now, which is probably above that level now. So I would also say that we saw the same move during this period. And to sort of add to the fact that, yes, over the past, 3 to 5 years, Bitcoin or cryptocurrencies have been very volatile, but we also have to understand that, the second part of the equation is what are you getting in terms of this volatility, the risk reward we are getting. And if you look from a more of a risk reward, or even more sort of technical speaking, a Sharpe ratio, right now we're seeing Bitcoin expressing or behaving a very a positive a Sharpe ratio, which means that there is a very good sort of risk reward looking at these cryptocurrencies, especially in the past few years.
And what about finally for those investors that'll just come back and say, hey, but it is an unregulated asset?
No. Oh, I would think that regulatory is along the way right now. I mean, in terms of what we saw last year, the US SEC approving cryptocurrency ETFs, I think that was a major step into regulating this asset class. We also obviously saw Australia allowing these cryptocurrency ETFs, which have seen very positive inflows, adoption, not just by retail shareholders, but also institutional shareholders. So I would really say that we are, of course, needing more and more regulatory in terms of cryptocurrencies. But in terms of investing in it, we've seen very, very strong regulations around this area, possibly even much better in terms of other or previous when there was no ETFs in existence for cryptocurrencies.
That is Billy Leung there from Global X ETFs. Now, Market Day on the SBS On The Money podcast. To the Australian share market now, which did fall. The S&P ASX 200 off by 0.5% to 8,348. Energy sector, the worst performing today, down by 1.8%, followed by IT. But the banks also saw a bit of profit, taking the Commonwealth Bank off its recent high. For that and more, I spoke with Scott Phillips, the Chief Investment Officer at the Motley Fool. Scott, the market's seeing a bit of a pullback today. Why, and how much of it has to do with the US?
Ricardo, g'day. Why and the US are exactly the right question and answer. It is almost entirely about the US. The US market fell 1.6% overnight. This has been the story of the last few months. I dare say it'll be the story of the next few months as well. We teeter between optimism and pessimism, fear and greed. At the moment, we're in the pessimism camp.
Okay, let's talk about the US then. To what extent are there concerns about the US economy, and how is it being reflected in the performance of US bonds? Because that's what triggered that sell-off in the US, wasn't it?
Right. So you've got the US economy and then you've got the US government, frankly, and they're kind of two different things. So the US economy, still significant fears of inflation and or recession, and the and or is valid because it could be both, right? The dreaded stagflation may turn up if tariffs push prices up and retard US economic output. So we'll have to wait and see what happens in their economy. But of course, if that does happen, that hurts the rest of us. The bond market's a challenge. The US government is having a hard time selling its bonds at the rate, at the price it wants to sell them, effectively at the yield. That comes down to concerns about whether or not the US will be able to pay its debts. Now, that sounds pretty ordinary. They'll pay the debts one way or the other. They can print their own money. But that money printing is exactly why a lot of potential bond buyers don't want to take the cheap price on offer. They're looking for more yield. They're not getting it. And that's concerning investors in both the bond and the equity markets.
Okay, still, if we're talking about the markets pulling back, yes, the ASX 200 is down today, but nowhere near the 1.6% fall we saw on Wall Street overnight. Why do you think that is?
I think it's probably rates, honestly. Both this week's decision and the potential for another cut next time the Reserve Bank meets. We saw it yesterday. The US market wasn't great. We did okay. Again, overnight, the US market was terrible and we're not off by as much. So it seems to be the case that there is, I would say decoupling, it's too early to call it that. I wouldn't call it that. It's not going to happen. But in terms of the extreme or the extent to which we're seeing changes, firstly, the biggest issues are US domestic rather than global. So you'd expect to see the US market fall more than ours. I think there is just some optimism that the rate cut this week, possibly another one next time the RBA meets, maybe another one again sometime later this year, suggests to the market things aren't as bad as they might be. It's also worth saying, by the way, when we think about these falls, we've recovered almost all of the losses that we made on the back of the tariff news. So to some extent, a full recovery is probably priced in. When that is not the case, or when the market thinks it's not the case, that's why we're seeing such big and sudden moves.
Okay, speaking of recovery, and I know a lot of market analysts don't necessarily like to talk about cryptocurrencies, but if I can just ask you about Bitcoin, because I think it's up in a couple of months, about 50%, right? It's a huge rally. It's back at record territory today. Do we know why?
There's two things going on, and they're really hard to pull apart because we're all trying to assess the motivations and the mindsets of owners and potential owners of Bitcoin. You've got two things happening. The first thing you've got is Bitcoin is operating much more like a tech stock than a currency at the moment. And the simple reality is when the market's excited, when things recover, you tend to see Bitcoin recover. That recovery over the past month or so has mirrored, or been more than, but mirrored the direction of the US stock market as a whole and the tech stocks in particular. Overlaid on that, you have got this safe haven sense of investors saying, you know what, we just talked about the bond market, if we're going to have troubles when it comes to the US selling its bonds, the potential for some sort of default or more likely money printing, quantitative easing, call it what you want, something that doesn't inflate in value, whether that's gold or potentially Bitcoin, is coming to the fore. And Bitcoin has matured as an asset. We know a lot of ETFs are being offered. A lot of people are coming around to believing in it. And so you've got this sense on both camps of, yes, it's a tech stock, it's recovering as stocks recover, but also when the market is worried about what's happening on the bond market with the US currency and inflation, Bitcoin is seemingly, increasingly becoming a safe haven asset.
And finally, I'm just curious to know what you're telling your clients at the moment, given the volatility we're seeing and where you see the opportunities for investors.
Yeah, the advice, we kind of alluded to it earlier, it's going to be a volatile time, right? Don't take too much for granted. Equally, don't get too disturbed when the market moves and when it falls. We know the Oval Office is going to be a volatile place for the next 3.5 years. This is going to be the new normal. So we're going to have to get used to the volatility. Really, really important not to get freaked out when the market's falling. In fact, if you can, take advantage of those opportunities. In terms of opportunities, really I hate the phrase a stock picker's market, Ricardo, because it always kind of is. But the reality is right now, if you think about where we're placed, because the market's up and near an all-time high, you've got to be a little bit careful that you're not buying the overvalued stuff. We're staying away from the banks in particular. CBA is incredibly expensive. So it is a case-by-case market. A little bit of value in retail, some in industrial, some unloved tech. But you've kind of got to go piece by piece. You can't be thematic in this sort of market.
That's Scott Phillips there from the Motley Fool. Don't forget, if you enjoy the podcast, to give it a rating or a review on Apple Podcasts and Spotify, and to click subscribe. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.